crypto realized vol collapsed as trading ranges remain intact. Implied vols hold up better ahead of key inflation data this week, and option volumes dropped 40%, but put protection buying in Ethereum sticks out like a sore thumb. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got David Brickell here from FRNT, and we've got a special guest from Block Scholes, senior researcher, Andrew Melville. How you doing, man?
Good, thanks. Nice to be here.
No, it's good to have you here.
So, yeah, we're getting bored of just the two of us.
Yeah, I know. I see it every week.
Yeah, nice to have you on, Andrew. Really interested for the conversation.
Absolutely.
So tell us, what are you guys doing over there at Block Scholes? I like the name, to be fair. It's a good name.
It's a litmus test, I think, for people who in crypto who know derivatives or not.
Yeah.
We get one of two reactions. It's either like, oh, nice name, or like, complete disappointment. But yeah, like the name suggests, we are research data analytics with for crypto with digital assets with a big focus on derivatives.
Okay. And who are you providing data to? Like, is it all institutional clients?
Big mix. Primarily centralized exchanges, decentralized exchanges, hedge funds, universities, traders, and it's a big plug-in to my research as well. So I sit on the research team. It's the big feeder into what we do.
And where do you get your data from primarily?
Primarily Deribit, liquid markets. We are pulling options price data. So wherever options are traded, we're trying to pull them in, and that's primarily Deribit. And
they still do like 80% of the volume, right? Or 85% of the volume, I think.
Yeah, pretty much. Yeah,
I think so. Definitely for sex, yeah.
Mm-hmm.
Yeah, it's funny as well because like I've seen like the Block Scholes stuff. We take it for granted, right? In the TradFi world, like of all the data and analytics that we've got available to us, and you remember, particularly from an institutional side, when you're in crypto, we're still building this stuff, right? So like what Block Scholes do is fantastic, particularly from an institutional point of view, in terms of having those sort of data analytics and the vol curves and the vol services and all these things that you sort of want to create. The fact that they're sort of building that, so it's brilliant. I mean, kudos to you guys and what you're doing.
Yeah, you're absolutely right. If you wanted to go and look at some equity vol trades, you would tap into the Bloomberg terminal, right? That's just not there for crypto. So we went out and built that basically from the ground up. The team's got a massive experience, I think 60 years plus of TradFi experience in derivatives, quants from Bloomberg, the like. Put together the vol surfaces and pushing that data now on a pretty good frequency. I wouldn't be able to do my research job without it. A lot of the trade ideas we're looking at completely driven by the insights, the metrics we're pulling from centralized and decentralized exchanges now.
And so what are the kind of, I mean, obviously I look at the vol market every week and I write my own reports and summaries about it. So, but what I'd like to know what your sort of insights are from like the trends that you've been seeing in crypto vol. Like, for example, this year we had that big rally after the ETFs. You know, we've had that cool skew go quite big, particularly in the long end. Spot vol correlation has been very positive, and maybe when you get we had that crash on the geopolitics, but apart from that, we've not really ever seen vol go up on the way down in spot. Is that something you think is going to persist going forward? And how do you have a way of thinking about what condition the market's in and whether spot and vol will be correlated or not?
There's a lot going on. I think it's a strange one right now. And truthfully, the issue is we don't have a big history of data for this, right? It seems like the regime shifts every year or so. So if you think back to 2021, where, like you said, spot vol correlation was massive. A lot of call buying at the same time as you have the futures curve essentially going vertical, right? Then in 2022, massive shift towards puts. It was persistent put buying, overcalls.
That's because obviously Luna, Terra,
validated
FTX,
in retrospect.
Scandal after scandal.
Absolutely. Then 2023, vol essentially died. Nearly went negative, if it's possible. But yeah, hit the lows in July. I think what we're looking at now is a tentative climb back from that. Obviously, the narrative that pushed that originally was the ETF. Now that seems to have dissipated a little bit. A lot of the ETF flows may be drying up a little bit towards the middle of March or so. And as a result, delivered vol crashing lower and then implied vol following. So I think what we're looking at a lot is a lot of relative value stuff on the term structure, on the surface in general, particularly flatness of the smile. This is a very strange one that reached all-time lows as implied vol.
So how do you think? Because there'll be some viewers who don't really know what you mean there. So how do you think about the flatness of the smile? What do you mean by that?
Sure. So thinking about implied volatility in the wings, so very deep out of the money calls, very deep out of the money puts, and comparing that to the level of vol at the money. When you have a very flat smile, those levels are very similar, and you could think of it as the volatility of volatility being low, and then in fact that's how we measure it using some models. And then when you have at the money volatility very far away from the out of the money, then you have a very steep smile. So I think some people might be more familiar with it with like the butterfly. This is a metric. You take the average of the vols in the wings and take the difference between that average and the at the money. What we saw was as implied volatility crashed down in July of 2023, at the money dropped, out of the money stayed put, stayed still, increasing that steepness of the smile. And then throughout the reversal in implied vol, as the at the money level rose, those out of the money options didn't really move so much, which meant that we had a really, really flat smile, maybe 3 weeks ago, 4 weeks ago now. So yeah, a lot of interesting stuff.
But like, what range does that smile trade in, for example? Do you think of it in vol points? Do you think of it average vol of the wings minus or is it divided by the at the money?
Yeah, I think both show you the same information as long as you're looking at the same thing throughout the history. Yeah,
so what would that range typically be?
That depends on how far out of the money you're looking at.
Sure.
I tend to prefer to look at this in terms of the Sabre parameter. So Sabre is a calibration for the volatility smile, has 3 parameters. Traders like them. They're very interpretable. Okay. You've got the level, you've got the skew towards puts or calls, which is positive or negative. And then you've got the vol of vol, which is like the curvature of that smile. But yeah, in terms of historical ranges of that, again, depends on the tenor that you're looking at.
But let's say, for example, 1 month, 10 delta wings, basically, something like that.
Yeah, I'd have to double check on exact numbers for difference in implied vol. Generally, I would start getting interested once that starts to push towards the top of its historical range. For 10 delta, I would just be guessing, I think.
So what's it telling us when that smile's super flat?
So those flies, right? So what? I mean, there's various products you can trade in derivatives, obviously in TradFi, and it's all building out now in crypto. But the most basic, the fly structure is where you sell the middle and you buy the wings, right? And you don't actually have any real Vega exposure when you do that. But when vol moves a lot, what happens is the wings, they shrink when vol goes down and they grow when vol goes up. So they have what we call convexity.
Yeah.
Whereas the at the money stuff doesn't really have any convexity. So if you're a buyer of wings and a seller of middles, then you want vol to move. You either want vol to go up a lot or down a lot. If it goes up a lot, you're going to kick into loads of long Vega. And if it goes down, you're going to kick into short Vega. So it's kind of like you're trading gamma on the volatility, right?
Yeah.
So you're buying vol gamma when you buy wings. So I think what Andrew's essentially saying is when vol's really, really cheap, everyone knows at some point it's going to pop. So they're willing to pay up for the convexity because it's just a matter of time from when crypto vol goes from 30 back to 60 again, right? But now that vol's at 60, it could go up to 80 and it could go down to 40 and it's kind of mid-range. So I'm not as willing to pay up for convexity because it could just stay here mid-range, right? It's not a given that it's going to move a lot. Is that fair to say?
Yeah, I think that's a great way of describing it. I would add to that, it's like very similar to the delivered vol versus implied vol idea, but looking at the volatility of volatility. Steepness of the wings is describing the implied volatility of volatility, how attractive big moves are compared to small moves at the money, and then comparing that to the delivered volatility of volatility. So are we seeing something like a child scribbling on a whiteboard in spot, or are we trending sideways a lot like we were, I suppose, this time last year, early 2023? Are we seeing spot move sideways for a long time and then suddenly spike up by 20-30% or so?
So what are we seeing in realized vol of vol? Is it low as well?
Low-ish, I think, increasing a little bit more recently.
And you talked about relative value being something you guys focus on a lot. So I bang on about the Ethereum Bitcoin spread a lot because that's the most liquid spread that you can actually trade.
Yeah.
Obviously, we're starting to see Sol options and Matic options trading and stuff, but still take a while before you can really get your teeth in across different expiries. I was pretty vocal about when the Bitcoin ETF approval happened. I was like, the new trade is going to be to buy Ethereum because that's the next narrative. So the spread was trading Bitcoin over back end of last year and then flipped into Ethereum premium, and it's kind of stayed there ever since. It's just a question of how much, right?
Mm-hmm.
What are your thoughts?
This is the spread in vol?
This is the vol spread between Ethereum and Bitcoin.
Yeah, absolutely. This is something we've been tracking for, I think, maybe 18 months or so now. Immediately following the merge in September 22, we saw a collapse of ETH vol premium against Bitcoin, right? So looking at a longer history of that, yes, we're back at that 5-7 point vol premium, that spread, but that is sort of new in that history. I think it took vol crashing to the lows in mid-20s in July for that trend to reverse and for Ethereum to start pushing higher on that premium. I think in terms of the relative value trade between Bitcoin and Ethereum, we really like this as an expression of the spot spread, I suppose, or the spot cross pair. Mm-hmm. We really like that we have liked that as an idea that could be expressed in options rather than purely in spot.
But which way round though? Like to buy puts on ETH and sell puts on Bitcoin, or to do calls?
I think directionally we're looking at following. We have been looking at following that trend. So since the merge, Bitcoin has massively outperformed. You're right. You mentioned post ETF. I think the expectation was that this would very soon follow for Ethereum. Mm-hmm. We've not seen that materialize almost whatsoever. Since then, it's been a lot of volatility around that trend, but we're at the all-time highs of people like to call it Bitcoin dominance, I suppose, but I mean specifically Bitcoin against Ethereum. Mm-hmm. So combining that maybe directional view, if you have it, with a relative value trade on in volatility. So finding places where Ethereum volatility looks expensive and selling something there, and then combining that with a longer view on Bitcoin. Mm-hmm. If you're long Bitcoin volatility relative to Ethereum. Okay,
so you're talking about using the premium that Ethereum vol has to fade that to own Bitcoin vol and then do that directionally. So I always go on about the other trade where I'm saying if Ethereum ever does bounce and has some outperformance, you'd be a buyer of Ethereum calls and seller of Bitcoin calls to participate in that. But what you're actually saying is because you don't think that is the way the trend has been, if you want to play a continuation of where the trend has been, you would do the opposite basically, because you're actually getting Bitcoin upside at a discount to Ethereum. So if you don't think Ethereum is going to have a catch up, then that's actually quite a nice trade to get into while if you think Bitcoin leads the rally.
Yeah,
right?
Exactly. Don't fight the market, essentially.
I love fighting the market, baby. That's what I live for.
I guess as well because you've got this kind of consistent overwriting flows as well that probably help that trade. So yeah. But I'm on the same side as Imran, and I'm still expecting at some point, like, because I mean, ETH just feels so beat up and it's so unloved.
Doesn't stop it going down all the time.
I love an underdog always, but yeah, you feel I feel at some point, like you say, that Bitcoin dominance. will start to wane.
Yeah.
And typically that's and obviously this time is different and all that stuff, but typically post halving, you do start to see the Bitcoin dominance fade and ETH outperform and obviously the broader alt space.
Well, the reason I love the trade, and I haven't pulled the trigger on it for ages. I had it on, can't even remember when I had it on, but I took it off because I was like, it's noisy and there's other stuff to do. But the reason I love the trade is because if ETH does continue to underperform, because you strike it in like 10, 15 delta upside on relative value, you don't end up having a position because you do it pretty much premium neutral. You spend no premium. You're only going to get into trouble if the whole crypto market rips and Bitcoin leads the way. If it just keeps drifting all sideways and Ethereum underperforms, you lose no money, right? So that's the beauty of it.
Yeah, it makes sense.
And that's exactly what's happened over the last month and a half. I think you would have gotten caught out quite a lot on that, I think.
Yeah, whereas if you just bought the spread thinking, oh, ETH can't go any lower, it's at the lows, where it just keeps going lower. So you would lose money, right?
Yeah.
Yeah. And what about skew? What do you think about crypto skew? I find crypto skew to just be so damn volatile, especially in the short end, and it's so unstable. But what are your thoughts on it?
Yeah, it seemed to have followed the sort of leverage argument in futures yields and in funding rate almost over the last, say, 4 months or first 5 months of the year. It does seem to be a place where people look for that convexity more and more so as the market matures a little bit and gets a bit more efficient. So you are seeing that sort of correlation between, well, I suppose, essentially spot move up, more vol, people are looking to express that in options. It seems like 2024 is another regime shift or at least it has been so far for skew. Like I said, 22 we were selling, 23 we did nothing, and then skew in 2024 has been up and it's been down, right? I think the interesting part is, again, relative value, particularly short end versus the front end. The front end versus the back end, because while the front end seemed very volatile, the back end stayed put. Stayed put fairly bullish as well, actually, which is a surprise given what Spot's been doing. So yeah, I would love to do a little bit more of analysis and understand why people aren't expressing that view in the longer term as they may have done in previous bearish modes, right?
Because I would have thought if a load of institutional money came into crypto, then there would be a natural demand for protection in the long end as well, like the structural put buying that you see in TradFi markets.
Yeah, in equities, S&P puts
exactly.
always bid, absolutely.
But you haven't seen that, so that kind of suggests that actually, like, the real money types are not in. And you've got the hedgies who are there actually buying calls to participate and get leverage in the upside. But the structural just, I'm long delta and I want to always be protected for like big drawdowns. That type of money doesn't seem to be in.
Yeah, I think it's still early days. Look, the ETF had the biggest explosion into an ETF in history or something like this, right? Mm-hmm. But we forget all of that liquidity has come in very quickly, and I think a lot of institutions may still be thinking about how to think about this asset class. Is it something like a risky asset? Is it something more like gold? Where does it belong in the portfolio? And how do I hedge it? How do I take its risk? My intuition would be that people are looking for volatility. So to sell vol or to hedge away that risk might be counterintuitive. If you're,
so they own it for the asymmetric upside, so then why would they sell calls? Is that what you mean?
Why would they sell calls? Yeah, absolutely.
It's funny because if you talk to like miners, and again, like I've looked at kind of selling structures where even just like a basic kind of collar structure to kind of hedge your downside a bit, and like they're never interested in the downside. Like, what do you mean downside? Like, they might look at ways of yield enhancement and stuff like that, to some degree on the upside. But what about protecting your downside? And there's still that we're up only, right? It's
just a religion. It's a religion.
Yeah, and it's kind of but you're so exposed. Like again, your convexity. If this world crashes, you're so exposed. But it's still it's still a feeling that it's kind of up only, and even like with sort of like the corporate treasuries from like blockchain companies, you kind of think, like we're all kind of very exposed directionally to Bitcoin going up. Actually, and I was having this conversation with someone earlier today at a conference, and it's in some ways, particularly when you're vol guys, like it shouldn't really matter, right? You just want volatility up or down, but there's still obviously in terms of the growth of the industry, you know, it's still very high beta to sort of Bitcoin going up. So in that regard, you kind of go, well then, like it makes sense to be hedged, because in a world where we have a 2022, you know, then at least your business might look pretty crap, but you're cleaning up on some of the hedges in place. But yeah, it doesn't seem that mindset there, and I think that's partly we're still very early in just thinking about risk in that way. And it probably does, to your point, like around the ETFs and stuff, as we've seen. Still not actually, if we all to talk about institutional adoption, the institutions are here in the sense of they're offering products, but the people buying those products are still very much at the retail end, or so we're still not seeing the big guys come in and take positions that they would then, you know, hedge with a little bit more sophistication around.
Yeah, I think the sophistication point is a good one. I'd question whether we would expect to see hedging of downside just look like buying out the money puts, for example. I think the trace of the marker, the signal for that would look something more like strange relative value shapes on the term structure or on the smile. For example, this flatness in the vol smile, I think, lent itself very much to something like a short put spread, for example. So playing that at the money versus out of the money.
But there's probably there, excuse me, it's probably there because protection buyers tend to buy put spreads rather than outright puts on these higher vol levels, right?
That trade has since gone, so maybe it is there.
Yeah.
Maybe it's been taken up, it's been eaten up.
Speaking of that, we did see a bit of protection buying this week. Volumes fell off a cliff though, because obviously it's been a boring week, right, for markets. Like it all went a bit quiet across all asset classes. But the standout was Ethereum. Chunk of end of May 3,000 puts got bought in like 2 million premium. So and then I think the 2600s also got bought, and a put spread collar in June got bought as well. So those were the only significant flows. So why do you think people are so focused on Ethereum protection rather than Bitcoin? Like, is Ethereum a bit more fragile right now for any fundamental reasons, do you think?
I mean, I guess which I kind of think is the wrong trade. If you're playing it on the back of, you know, not having the ETFs approved in May, seems a little bit ludicrous, given that I don't think anyone really thought they were getting approved. Yeah, and still, I mean, it doesn't trade well, I must admit, as someone who's still like quite bullish on ETH.
Yeah,
we've seen as well, like you know, since the Denken upgrade, you like obviously seen fees come down a lot.
Yeah,
which has now mean the burn rate now is ETH is now inflationary again, no longer in deflation. So you kind of keep knocking away some like the positive aspects of why you would have been maybe bullish before. So yeah, so it just feels a little bit unloved, and then like with the increased like regulatory scrutiny, there's a fears about that. But again, like for me, that's perhaps where the opportunity is.
But BlackRock have said that they don't see their clients really demanding Ethereum ETFs like they did Bitcoin as well, right? So that's kind of taken some of the optimism out of it as well.
Yeah, and it's just and you kind of feel like if we were to correct further, just more broadly, and Bitcoin corrects further, you know, it does feel like ETH would be like, you know, a stone through a wet paper bag, as they say. I used to say.
Yeah.
It does feel like that, right? It's like
straight to 2,500 or something.
Like, that's probably the easier one to push, because there's probably still a natural kind of source of demand for Bitcoin right now. It doesn't feel that way for ETH, but you know, it's always darkest before dawn, right? So it's probably for me again like the time where you're like, right, how do we fade that? How do we maybe sell some of that skew and look to sort of participate a bit more in the upside?
And a question for you, Andrew, like with the metrics that you guys send out to your clients and stuff, do you see a lot of clients focused on systematic trading in crypto options? like, for example, systematic carry harvesting, vol selling, whatever, things like that. Is that do you think that's a large part of what these guys in crypto vol space are doing? Because that's kind of what I see happening, but I'd like to see what you see.
I think it's a healthy mix. I think a lot of the relative value stuff that we're looking at lends itself to being systematized quite easily, just because it shows up as an opportunity when two metrics look like they've been pushed to the extreme in their joint distribution, say. But what we're looking at, yes, we do the sort of back testing, the systematizing. We're looking for new opportunities. We are working with our clients to find the right way to express views that they have and ways to hedge risks that they have in particular. Things that are maybe less away from the alpha in the market, inefficient market. How do I eat that up? And more, how do I plug options and derivatives into my wider portfolio? How do I make it fit in with maybe my macro view or my view on crypto?
So you make sort of tailor-made solutions for your clients to some extent?
Exactly right, yeah.
Right.
So we work with a couple of different hedge funds, liaising with them on a weekly basis, staying in touch, monitoring portfolios for them, suggesting ideas, using our regulation from the FCA to push trade ideas that suit them in particular. Speaking
of that, nothing we ever say on this podcast is financial advice. This is just me talking about the trades that I do and just giving pure education. And remember, if you like what we do, then like and subscribe to the channel so you get that education for free on these videos. Now, we've talked a lot about vol. Any changes in the macro?
Not huge change. Obviously, this will go out probably.
This will go out just before CPI tomorrow.
Yeah. So CPI is obviously a big data point. And actually, the interesting thing is we have kind of reconnected with the macro. Like we had a bit of a sell-off, Friday, when we had the Uni Mitch number come out, which is quite stagflationary.
Mm-hmm.
Basically, consumer confidence falling, inflation expectations rising, which kind of saw yields perk up, dollar perk up, and Bitcoin got hit.
Stocks held in well, though.
Yeah, stocks held in well.
Yeah, like crypto got whacked.
So again, sometimes it feels like Bitcoin's like the ultimate kind of macro asset. That sort of leads a lot of things. But I don't think too much has changed. What was interesting is, I think we spoke before about China doing QE, and there was the article about a month ago, I think, that back in November, Xi sort of basically said to the PBOC that he'd like to see them participate more in the bond market. Now, this week they've announced that they're going to be launching like the ultra long sort of bond issuance of about, I think it's about $148 billion equivalent.
Mm-hmm.
And the PBOC indicated in April that they might get involved in that in the secondary market. So essentially, that looks and feels a little bit like, I called it QE with Chinese characteristics. So it feels like a lot of liquidity is going to come in from China. They had their social financing data over the weekend. Like basically, credit is not flowing. So all that they're trying to do is get credit flowing. Companies aren't borrowing, banks aren't lending. Now, actually, on the one hand, that's kind of a negative liquidity kind of event for crypto. The flip side to that is that the PBOC will get more aggressive in terms of trying to force sort of liquidity into the market. So I think that bond issue is quite important. I think that's why we popped up to 63K on Monday morning, and everyone was like, "What's going on?" I don't think that was any pre-positioning for CPI. I think that was all about China bond issuance. So I still think keep an eye on China. I think we're set to see liquidity sort of really pick up there. I've spoken about we got a much better liquidity outlook for the US as well throughout Q2. Obviously, the tapering of QT means that there's an extra 35 billion of liquidity essentially in the market. We've got the bond buybacks, 2 billion a week come in. The Treasury buybacks come in end of May through July. So generally a lower sort of bond issuance sort of calendar throughout Q2. relative to what we saw in Q1. Last week, there's quite a big deluge of treasury issuance, 125 billion of, I think it was like 3-year, 10-year, 30-year treasuries.
It got digested fairly well, right?
It did, and I think again that has still a negative liquidity impact. That doesn't help because we want to kind of take out that 65k level. I actually think it shows me I'm quite bullish on bonds here. I think sort of given that kind of dovish Fed that we saw, given that liquidity, given these what feels like yield curve control, I think the fact that yields kind of stayed pretty well anchored given that issuance, I think once we get past Wednesday's CPI, which I kind of think again is quite asymmetric in terms of the impact, because if it's stronger, then the Fed have told us they're not hiking, right? And we price out a bit of when the cuts come.
But we're down to 2 cuts this year, right?
Yes, maybe we price it out basically a cut in December, and that's that. But there just seems limited impact from that. If it's weaker, and we have to start more aggressively pricing that in, so the bigger reaction to me will be on a weaker print. So I think like the market will wait for that. It's really difficult who straps on risk into something like that. I think once we're past that though, these liquidity elements and that will start to take over. So I do think there's an asymmetry. Might look stupid by this time next week, but I think there's an asymmetry in that.
I'll tell you where there's asymmetry. In the meme stocks. Have you seen?
So the biggest thing.
Unbelievable. GameStop is back.
Roaring Kitty's back.
Yeah, well, exactly. And that's why GameStop is back. I mean, it's up over 100%. In fact, probably like 200% now. It's insane. Right. But I wonder if that's going to be a negative impact to crypto in the near term. Because if you've got all these retail traders suddenly wanting to speculate on stonks again, right? Then they're not going to be trading meme coins. They're not going to be trading crypto as much. Their focus will move to something else. So it might just be activity within crypto grinds to a bit of a halt, and maybe vols a massive sell for like the next 3 weeks. And then obviously when the episode is over, like it will probably be over, then you can get back to crypto bull market. But I just wonder if that has some read through.
See, I interpret it as being bullish in the sense
of course you do.
Yeah, but like we've not had much retail participation, right, in this sort of bull move that we're seeing. A lot of it has felt very institutional, and we're certainly not seeing like the same levels of like euphoria that we saw in like the 21 bull market.
No, true.
And there's been a lack of that retail participation. I actually wondered whether like all the silliness around that just brings in just that retail kind of frenzy, right? What's moving a lot?
I don't see it, man.
Yeah,
I don't see it.
And then the other thing, obviously, like the TradFi stonks, they stop trading, right? They have the circuit breakers and all that stuff. So it's like, right, well, where else do you get your fix?
Nah, see, I think that's wrong. I think what happened was you had stonks, and then you had crypto, and then you had tech stocks, like mega cap tech stocks like Nvidia and Tesla, and not Tesla, but Nvidia, AI stocks, right? And now then you had a bit more crypto again, and now stonks, right, again. But I don't think that's necessarily a positive this is just my read on it, but I just don't think that's a positive read through for crypto. Not in the near term. I think crypto needs its own reason to rally. I don't think speculators chasing AMC and GameStop are going to be the thing that fuels crypto higher.
Yeah, but then that Elon Musk is going to come out and there'll just be all pictures of that dog on a rocket and
this is that volatility that you can't predict.
Yeah. To be honest as well, like Stefan, a CEO at FRNT, like we talk about this stuff and we kind of laugh about it, and it is fun, right? Part of us, coming to crypto for that fun element. The flip side is that, particularly us guys who are in like the more institutional focused areas, you're like, do you know, like we believe in this asset class as a macro asset class. We're building an investment bank essentially for crypto, and it's a serious business, and it does we kind of feel like, particularly when you're trying to get the SEC on side and the regulators, you feel like it's not doing us any favors, guys. Come on, like all the
meme crazy stuff. Yeah, I agree.
Even though it's good fun, and I'll now be on Wall Street Bets just seeing what are they talking about now.
At the same time, did you see the Franklin Templeton, the Twitter account?
No.
I think an intern got a hold of it and changed the profile pic to laser eyes. I think this is the yeah.
That's funny.
So institutions coming in and with the same attitude is really not what we expected. Not what I expected. At
I
least.
don't know about you guys. I kind of feel like it's the year of the meme this year. It's just there's so much. I don't know. There seems to be this pent up demand to just chase memes, whether it's meme coins or meme stocks, whatever it is. It just seems to be the thing that. So clearly, animal spirits are there, right? They just need to be galvanized by something. Something has to capture their attention, and then they just flock to it, right?
Yeah.
But that seems to be the world we're in. So it kind of. Yeah, does that mean there's still just too much money sloshing around, right? People have got money to gamble with because they're gambling on stuff that arguably has no fundamental value.
Yeah.
You know?
Well, then what's your saying around trading options about the altcoin-like returns?
Yeah, that's right.
Yeah.
Altcoin low returns. Imagine what options on GameStop are like now.
Yeah.
Crazy.
Right.
Anyway, let's call it a day. It's been a pleasure having you on and learning
really
about what you
interesting,
guys are doing at Block Scholes.
Great to be here. Thank you.
And we'll catch you all next week.